Welcome back to the channel, everyone. Today I want to talk about how massive liquidations are happening right now and how bailouts are coming just around the corner and could be happening right under our noses. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, I want to start by talking about the continuation of the global financial crash and the global financial recession. Investing.com has been tweeting the futures prices all around the world over the last few hours. And trust me guys, they don't look great. European markets are down 2 to 3%, Asian markets are down 1 to 2%, commodities are also down 1 to 3%, and cryptos are down 10, 20, and even 30%. We can see here the UK FTSE 100 is down 2.37%. The Hang Seng Index in Hong Kong is down 2% as well. We've got tons of commodities like oil, natural gas, silver and copper, all down 1, 2 and 3%. And then in terms of crypto, we've got Bitcoin and Ethereum down 10 and 18% respectively. We've got some slightly smaller cryptos like Solana down 30%. And obviously Luna is now down 97%, trading for only a few cents. Jonathan Ferro has tweeted about the absolute carnage so far in 2022. We've got Netflix currently down 72.4% for the year, which is Netflix's worst year on record. Again, Facebook is also down 43, nearly 44%, the worst year on record, and many stocks like Amazon, Microsoft and Google are down 35, 22 and 21%, their worst year since 2008. This is absolutely crazy that we have massive stocks like Google, Microsoft and Amazon down 20 to 30% already, and the global crash and recession only seems to be getting started. H. Meisler tweeted saying Amazon is down almost 40% since early April. He said, I mean, come on, this is not Roku or Coinbase or any other kind of crazy small growth stock or startup. This is Amazon down nearly 40%. And I think this is what has me worried the most. We've so far only seen the S&P 500 fall by 17%, and the market crash and global recession only seems to be getting started. So far, we've only had one straight quarter of negative GDP growth, so we're not even officially in a recession, and the S&P 500 isn't even officially in bear market territory just yet. The S&P 500 has only fallen 17% and doesn't officially reach bear market territory until it's down 20%. And therefore, we're not even officially in the recession yet, as we haven't had 2 quarters of negative GDP growth, and we have some of the biggest stocks in the market already down 20, 30 and 40%. And the thing that tells me the current recession will end up being very, very damaging is the fact that we already have massively contradicting and conflicting opinions. Wells Fargo have just said in order to tamp down inflation, we now believe the Fed will raise the effective federal funds rate at a slightly more aggressive pace this year and look for a 50 basis points hike at the June, July and September FOMC meetings. And therefore it looks like the Fed will have to raise the federal funds rate by at least 1.5% before the end of the year to even start fighting inflation, if not even more than 1.5%, potentially 2, 2.5% or even more. As May and June progress, we could end up seeing this 50 basis point hike reaching up to 75 or 100 basis point hikes each and every time. But on the flip side, we've also got Cathie Wood saying the global economy is already in a recession, and recent stock market volatility is a sign that investors believe the Federal Reserve's plan to continue hiking interest rates is far too aggressive. And as Jeremy replied saying, I think she might be right with this statement. But on the other hand, to kill inflation, you essentially have to kill demand. What better way to kill demand by making sure a lot of people can't buy stuff anymore because they can't afford it? The Fed obviously has to raise this federal funds rate to fight inflation, because otherwise if inflation is not fought off, everything will start becoming too expensive and the US and the UK and the entire world will end up in more of a poverty situation. But obviously on the flip side, while the Fed is raising these interest rates, it's causing massive damage to the global economy, not just impacting the US stock market, but as I showed earlier, also impacting the European markets, the Asian markets, commodities and crypto. And now I also want to talk about how insurance funds and the Fed are likely going to have to bail out many hedge funds over the coming few weeks and the coming few months, and so far I think have been doing so already. Now guys, many of you may not have a lot of confidence in the stock market at the moment, but Cathie Wood believes that crypto is currently nearing the end of the bear market, and therefore if you want to sign up to BlockFi using the link in the description below, you can currently get up to $250 in free Bitcoin. BlockFi also offer tons of other cryptocurrencies like Mana or Decentraland, Sand or Sandbox, Matic, Solana, Doge, and many more. And that's why more than 500,000 people in 350 institutions globally use BlockFi to manage over $10 billion in assets. BlockFi as a platform is also entirely free and requires no minimum balance. So guys, be sure to sign up to BlockFi using the link in the description below to get up to $250 in free Bitcoin. Allianz is obviously one of the world's largest insurance funds, and their hit from the recent hedge fund implosion now totals $5.9 billion. The insurer has also set aside a further 1.9 billion euros to resolve current ongoing probes. Investors are claiming they lost billions from the Allianz hedge fund collapse and are now demanding their money back from the Allianz insurance fund. So far, we've already seen over the last few months a number of hedge funds going bankrupt and investors losing tons and tons of money. Investors try and claim as much of their money back as they can, obviously from the SIPC and from separate insurance funds. And I think what's most worrying is that obviously insurance funds don't have unlimited money, and at some point they are going to run out of money to repay to investors. And then at that point, Fed bailouts will be needed. This article says Allianz is setting aside an additional 1.9 billion euros to resolve lawsuits and regulatory probes tied to the collapse of a group of its hedge funds 2 years ago at the start of the pandemic. Obviously, when the Allianz hedge fund collapsed, they were obviously sued by tons and tons of individual investors, and now the Allianz insurance fund is having to backstop and basically pay out money back to all of those investors. It says the additional amount is a fair estimate of the remaining exposure, including potential payments to resolve government proceedings, Allianz said in its statement on Wednesday. It says the charges bring the total cost from the implosion of the Florida-based structured alpha funds to 5.6 billion euros after the insurer announced a 3.7 billion euro hit earlier at the first round of settlements with investors. And obviously, as more and more hedge funds are collapsing, more insurance money is going to be needed for these investor settlements. And I think these insurance bailouts and Fed bailouts are only going to be exacerbated when many of these hedge funds start marking their private investments and also their startup investments. Now, you may have heard a lot about Tiger Global recently here on the channel, and their current problems are also compounded by major stakes in many tech startups. The hedge fund roiled the venture capital world by putting huge sums at eye-watering prices into late-stage companies in the last few years. The author from Tremendous Blog says, as an angel investor, I've had many deals that Tiger is in cross my desk. I can confirm they tend to invest huge sums of money, often over $100 million, in startups at staggering valuations. And it also says that Tiger is also well known for doing little, if any, due diligence on these companies, and it's likely that Tiger's fast and loose approach could have led it to invest in many weak or even fraudulent companies. Now, obviously, many of these fraudulent startup companies aren't yet listed on stock exchanges, but still have these staggering valuations that Tiger Global is using to meet its margin requirements. And obviously, as we saw in the film The Big Short, when these companies are forced to be fairly valued or forced to be fairly marked, we're going to see hundreds of millions, if not billions of dollars wiped from Tiger Global. And obviously, if Tiger Global suffer another giant setback like that, losing 10, if not $20 billion, they'll almost certainly fail to meet their margin requirements. And obviously at that point, when they fail those margin requirements, they will end up being margin called. And obviously Tiger Global has a fund size of around $80 billion. And therefore that's $80 billion of stocks like Apple, Microsoft, Tesla, and many others that will all of a sudden flood into the market and crash the prices even further. Crazily enough, it says Tiger's losses may be much worse than 50% when you account for its startup investments. Valuations of late-stage companies like those Tiger invests in are down over 20% from last year already. The author says it's easy to hide these losses because unlike publicly traded stocks, the price of these privately held shares seldom changes, aka these shares aren't valued too often, whereas listed companies are obviously valued every single second of every single day. And he says, but sooner or later the chickens will come home to roost and these private companies will be forced to be marked accurately, and Tiger will see a massive portion of its fund just disappear like that. And on top of that, it says money locked up in these startup investments could also cause a liquidity crisis for Tiger. Not just for Tiger, but for many other funds as well. It says if investors are spooked by losses and ask for their money back, Tiger can't get their money back easily and they have to dump stocks at fire sale prices. And obviously this doesn't just impact Tiger, it impacts many other funds like Melvin Capital, for example. When investors start to panic, which they almost certainly are right now, they will start asking for their money back and these hedge funds will be forced to dump billions of dollars, if not trillions of dollars, in stocks. And exactly as this author writes, it says this illiquidity also makes Tiger and many other funds vulnerable to margin calls. After its huge losses, brokers may demand more collateral. With big losses in public markets and the rest of its money locked up in private ones, Tiger may not have the cash. Yesterday, the S&P 500 convincingly broke this $400 region, closing the day at 392 points. So far today in the pre-market, it's looking like the S&P 500 will open under 390 points, reaching lows of 388. Therefore, again, it looks like another red day for the S&P 500, where we could see it obviously break below 390, potentially on its way towards 380. And obviously from there, it really isn't too long until we start reaching those pre-pandemic lows between 330 and 350. Guys, be sure to leave a comment down below and ding that notification bell so that way you'll be alerted when I upload a new video. Cheers.